Hi, I'm Christina Sewick with Windermere Real Estate. I'm the owner here of Windermere Real Estate, Scottsdale Old Town. Today is Monday, October 16th. I wanted to jump on here today and talk about mortgage rates. They are sure a topic of discussion right now, being that we are facing rates near 8%. So on Friday, when I joined you, our 30-year fixed mortgage rate was at 7.66%. And I'm realizing now I need to change my banner on here. So anyways, I will make a note on that. That is incorrect, the banner that's going down at the bottom of the screen. It is actually today, it's October 16th, and we are at 7.8%. So you can see the difference from when I joined you on Friday to where it is at now. So today we are at 7.8% for the 30-year fixed. And why is that? What happened that made these rates go up? So mortgage rates today jump back near long-term highs. So let me take you to that. So last week was mostly good for mortgage rates, even if the goodness was made possible in large part by the badness of the previous week. By Friday, rates were at 0.15% lower than the previous Friday on average. As the new week begins, virtually all of that progress has been erased. In other words, the average lender now is very close to the same rates seen on Friday, October 6th. But why? Unlike those moments where we have a clear culprit, like a strong jobs report or higher than expected inflation numbers, today's rate spike is a product of vague generalities. If you're determined to try to connect the dots, here are a few ways to try. The gap between longer and shorter term bonds experienced increased volatility last week due to geopolitical issues and new messaging from Federal Reserve speakers. Part of today's weakness is a reflection of that volatility continuing to be played out. Traders were more upbeat on bonds on Friday, possibly reflecting the closing of short-term positions, bets on rates, which were closed by buying bonds. This pushes rates lower ahead of the week with increased geopolitical risk. Those traders are re-entering their short-term positions at the start of the new week. We may have a chance to see more normal reaction function tomorrow after the release of the retail sales data from September. Even then, geopolitics and Fed speeches can continue to cause unexpected volatility in the short term. Moreover, we continue waiting on a unified theme of slower economic growth reflected in multiple reports before we'll truly be able to identify a big shift going towards lower rates. Okay, let's jump over here to this article. Oops, we're going to come back to that one. One second, this one. Okay, so current mortgage rates. What are today's mortgage rates? This was at the beginning of today. Average rates edged lower last Friday, like we've been talking about, but despite last week's delivering some improvements, they remain very high for 21st century standards. Earlier this morning, the markets were signaling that the rates might rise. And then earlier today, they thought, however, that change may pass in the hours, but it didn't. And part of the reason that it didn't, we'll get into here. But when you take a look at the 10-year yield, so the 10-year yield is over here, and it's at 4.71. On Friday, we were down into the 4.61750 range. And that was in the 30-year fixed was at 7.66. So anytime that we move away right now from 4.5% on the 10-year yield, and we go up away from that number, so obviously 4.7 is up away from that number, you can expect that the rates are going to rise more that day. Okay, so jumping back over here. How your mortgage interest rate is determined. So these are some factors to think about and what's going into today's rate. The overall strength of the economy. A strong economy usually means higher rates, while a weaker one can push current mortgage rates down to promote borrowing. Lender capacity. When a lender is very busy, it will increase rates to deter new business and give its loan officers some breathing room. Property type, condo, single family, townhouse, etc. A primary residence, meaning a home you plan to live in full time, will have a lower interest rate. Investment properties, second homes, and vacation homes will have higher mortgage rates. Loan to value ratio. Your loan to value ratio compares your loan amount to the value of your home. A lower LTV, meaning a bigger down payment, gets you a lower mortgage. Debt to income ratio. This number compares your total monthly debts to your pre-tax income. The more debt you currently have, the less room you'll have in your budget for a mortgage payment. Loan term, loans with a shorter term, like a 15-year mortgage, typically have lower rates than a 30-year loan term. Borrower's credit score, typically the higher your credit score, the lower your mortgage rate and vice versa. Mortgage discount points. Borrowers have the option to buy discount points or mortgage points at closing. These let you pay money up front or lower your interest rate. And remember now, you can also ask for seller paid closing costs in this market, and 1% is a quarter point when you're looking at that. So if you have house price is $800,000 and a seller wants to offer 1 percentage point off, that's an $8,000 credit, and that'll bring down your loan amount by 0.25 of a point. So that's just something to consider as well. And right now here in Arizona, there are a lot of seller concessions. So make sure that you talk to your real estate agent about that. Or if you want to reach out to me, I'm more than happy to talk to you about it as well. And then I'm not a mortgage expert here. I'm just trying to provide more clarity on what's going on today and why the mortgage rates are so volatile, because they definitely are out there today. Okay, and here was an interesting article. I always get asked, is this market that we're experiencing today, is it very similar to 2008? And my answer is no, that it is not. But this was an interesting article that the housing market is following a similar playbook from the 1980s when mortgage rates doubled. Here's what it can mean for home buyers today. So let's see what this is about. There are striking parallels between today's housing market and the housing market of the 1980s, according to Bank of America. High inflation, surging mortgage rates, and pent-up demands for homes from a growing demographic boom are just some of the few similarities between today and 4 decades ago. We think the 1980s are a better analogy for today's market than the 2008 housing crash, Bank of America said in a note on Thursday. Inflation soared through the 1970s and into the 1980s. Mortgage rates doubled from about 9% to 18% in 1981, and baby boomers were entering their prime home buying age. Fast forward to 2023, inflation has surged. The average 30-year fixed mortgage rate has doubled from 3% to about 7%, and millennials are driving pent-up demand for homes as they enter their prime home buying age. So what does this mean for housing market to go forward? It means that the prices are unlikely to rise from here and could slightly fall, but not as much as they did during the 2008 housing crash, Bank of America said. I agree with that, and I don't think anybody really has a crystal ball on that, but I think prices are going to stabilize and maybe come down a little bit. They're definitely not going to crash, in my personal opinion. The question is, how long can today's consumers stomach high mortgage rates as it pushes affordability for millennials to unobtainable levels? Persistently high mortgage rates should make the decision for purchasing a home they will make the decision of purchasing a home more challenging in the near term. Indeed, favorable demographics were not enough to hold up the market in the 1980s and will likely not be enough to stimulate the market this time around. There are other similarities between today's housing market and that of the 1980s. The bank added, home prices surged over 16% in 1979, then essentially flatlined as year-over-year growth slowed, just 0.5% in 1982. Additionally, homes existing sales fell 54% from peak to trough. After the COVID-19 pandemic, home prices jumped nearly 21% before flatlining 0% year-over-year growth. Meanwhile, existing home sales have plunged nearly 40%. And think about that. So here in Phoenix, Arizona, we were up. Our height of our market was around April of 2022. And then we went down a considerable amount, about, in the 20% range. And we've since made back most of that that we lost, or maybe a couple percentage point or here or two off, depending on where you are located around Maricopa County. But we've come back from those numbers. So for now, there's no sign of excessive housing development, and household debt is not much of a concern, B of A said, but warned there should be more turbulence ahead as prospective home buyers struggle to keep up with soaring mortgage rates. Limited inventories, high prices, and labor shortages can be headwinds for some, but the good news is that single-family permits have held up for the last several months. Affordability is likely to improve as the Fed cuts rates. At that stage, we should be able to see a more stable housing market. Until then, hang tight and maybe a bumpy ride, Bank of America concluded. So yes, I think right now, it's definitely volatile. If you find that interest rate, or rather that payment that you feel comfortable at as a buyer, I think that you should go ahead and buy the house. Not because I want to push anybody into buying a home, or that I just want to say now is always a great time to buy. That's not true. It's not always a great time to buy. If right now you don't feel comfortable and you're priced out of the market and you just think that, gosh, I can't, what I want, that's just not out there, don't buy something that you don't feel comfortable with. Absolutely not. if you're in a position as a buyer where you feel like you could make some adjustments, maybe not get everything on your checklist and find a home, maybe not in your preferred location, but a nice location, and you feel comfortable with that payment, I think it's a good time to build equity. I think as we head towards 2030, we're going to be appreciating throughout the course of this decade. Typically in every decade, where you start and where you finish the end of the decade is much different. Homeowners tend to gain a lot of equity over the course of a decade. Historically, that's happened every single year. I know since I've been looking at it, let's say from 1980, so for the last 4 decades, that's been true. I think they're not making any more land. So if you can jump on it, I think it's a great way to build wealth. But sometimes, as a seller, maybe you can't be the buyer because it just doesn't make sense for you to sell. I was talking to a seller today and I let them know, I can't advise you to sell your home at this market if you don't have to. So I think it's definitely important to find a real estate agent that you know, like, and trust that will give you honest answers, no matter what those answers may be. And I don't have the answer for you specifically. You're going to have to make that decision, but I am here to hopefully provide you with all of the data so you can go ahead and make the best educated decision for yourself. All right. Thank you for tuning in today. I hope that was a little bit beneficial. I'm Christina Sewick. I'm the owner of Windermere Scottsdale Old Town, and I will be with you later on this week. Have a great day.